Hello everyone, it's Yashar here, back again with another video, and in this video I'm going to talk about Alimentation Couche-Tard stock. Believe it or not, I actually did some research to understand how to pronounce the name of this company. This is a French name, and I read in a Reddit post that Couche-Tard means night owl or somebody who goes to the bed late. And I think the current French pronunciation is probably something different than what I'm saying right now. I mean, here this user said you should not pronounce the D in the tar and E in the couche, so it is Couche-Tard? I'm not sure. Apologies to anybody who speaks French. You can correct me if I'm wrong. Anyway, I will discuss their business, their future plans for 2022 and beyond, the dividend, the risk associated with this company, and finally I will provide you a detailed stock analysis using my personal discounted future earnings model, and will then provide you with a fair value of this stock depending on your investment goals. The company HQ is located at Laval, Quebec, and their shares are traded on TSX for almost 61 Canadian dollar at the time of recording this video. They pay a quarterly dividend with a starting yield of less than 1%, and the market capitalization of the company is around 62 billion Canadian dollar. Alimentation Couche-Tard was a growth beast in the last decade, and their performance was really top-notch. For example, in the last 5 years, the performance of Couche-Tard was significantly better than S&P 500 as the average return of the US market. It was even better than most of the high-growth tech stocks like Amazon and Microsoft. In this video, I want to analyze their business and estimate the fair value of this stock depending on your investment goals. Before starting the video, I want to emphasize that I'm not a financial advisor. This video is not a financial advice for you to buy, hold, or sell this stock. This is just my personal opinion. You should always do your own research before making any financial decision. With that being said, let's start this video. Couche-Tard owns more than 14,000 convenience stores and gas stations in 24 countries around the world, including European countries, Asian countries, Canada, and pretty much every single state in the United States. You probably visited at least a few of their locations in your life if you ever traveled around North America and stopped at a gas station under the brands of Circle K, Couche-Tard, or Ingo in Europe. They highlighted the fact that they sell 35 million gallons of fuel, 750,000 cups of coffee, and 490,000 hot dogs every single day around the world, which is an insane amount of sales. Almost 66% of their revenue comes from the sales in the United States, 13% comes from the sales in Canada, and 21% comes from their sales in Europe and other parts of the world. However, the fuel sales are almost 72% of the revenue, while merchandise and store sales are only 26% of revenue. However, it's very important to highlight this fact that the margin is much higher in those store sales and merchandise sales, and 51% of their total profit comes from this type of sales. Couche-Tard own almost 5% of fuel and convenience store market in the United States, which means while Couche-Tard is huge, they still have room to expand their business, grow, and take more market share even in the United States. Couche-Tard is a recession-resistant company, and their performance during previous recessions is a proof that this company can definitely continue to grow and improve their sales and margins even during the worst economic conditions and recessions. Couche-Tard was able to grow their business based on both development of new stores and opening new locations, which we can call it organic growth, and also successful acquisition of various convenient store chains and gas stations in the past. However, their plan is to be able to shift the focus of their growth from acquisition-focused growth to organic growth in the future, which is something nice to see. In terms of the financials, Couche-Tard was able to grow their adjusted earnings per share by an average 20% year over year in the last 10 years, which is an absolutely amazing rate of growth for this business. They also had a great growth in the profitability and margins in their business. Their fuel gross profit has been increased 20% year over year in the last 10 years, while their margin on merchandise sales was also grew by 10% year over year. All these growth numbers achieved while they were also able to keep a very healthy level of return on capital employed of around 15% in the last 10 years, which is absolutely amazing. Considering they had numerous large acquisitions in the last 10 years, these numbers actually looked even better. It means the management of Couche-Tard knows capital allocation very well and are able to return huge value to investors in the future. Couche-Tard has a long history of paying out and increasing its dividend year over year. In the last 10 years, Couche-Tard aggressively increased its quarterly dividend with an almost 25% increase year over year, which is great, which is very fast pace of dividend increases. They also bought back shares close to 4.5% in the last year, which means the management of the company is now focused on returning value to shareholders more and more. I also like the fact that their dividend payout ratio is very low, less than 20%, which means they have huge room to increase this dividend in the coming years. Couche-Tard has a great balance sheet with virtually no current debt and a very manageable level of long-term liabilities. With huge amount of free cash flow that they can generate annually, they can easily pay off any debt within a reasonable amount of time, so I'm not worried about their balance sheet and their debt. They are also focusing on EV charging stations in their locations, which can actually be a huge upside for future of Couche-Tard and can basically ensure investors that they will be in the business even if we transform from gas to electric vehicles in the future. With EVs, I actually think Couche-Tard would be even in a better place. I believe this business has a very defensive nature, as most people need to charge their cars or put gas in their car during travels, and they will also shop from Couche-Tard stores while waiting for the cars to be fully charged. Overall, this investment has a very low risk on the downside in my opinion, and a very attractive growth potential on the upside. I really like the risk-reward profile of the Couche-Tard. This is my favorite part of the video where I can show you my stock analysis based on the financial data I discussed in the previous parts of the video. I use a discounted future earnings model here, which basically estimates the value of stocks based on projections of their future earnings. So I make some assumptions about the growth of the company in the next 10 years and then discount the future earnings into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter diluted earnings per share of the company, and based on 3 different scenarios, I predict the future earnings of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow their earnings by 15% in the short term, and then the growth rate will slow down to 8% in the long term. They currently have a 20% average annual growth, so I think this is a conservative assumption. I consider terminal multiple of price to earnings of 12 for this case, which is consistent with historical bear periods of this stock. For normal case, I consider a little bit better growth and a terminal multiple of 17, which is historical average multiple for this company. For the bull case, or the best possible outcome, I consider the business grow by 25% in the short term, and then the growth rate will drop to 16% in the long term. And I considered a terminal multiple of 22, which is a bull multiple for this company. Now, I assign a 50% chance to the normal case, a 25% chance to the bull case, and 25% chance to the bear case. For growth stocks, I usually expect 15% return, and for dividend or large stable stocks, I expect 10% return. With Couche-Tard, I actually expect a little bit better return than 10%, as I believe this is a growing company, and I need some margin of safety. If I expect a 12% return from this company, the fair value of this stock is almost $63 Canadian dollar, which means compared to the current share price of almost $61, the shares are traded almost close to their fair value, which means it is a buy according to the model if you're happy with the 12% year-over-year return. It's always fun to see what analyst predictions are for the company, and according to Yahoo Finance, the analyst price target for this company is currently at around $70 per share, with a strong buy rating. However, it is a hold according to the research team and CFRA analysts. In summary, Couche-Tard is a great business with recession-resistant earnings and excellent growth history in the last decade, with a management team which is focused on returning value to shareholders via dividend and share buybacks. After researching the company, I really like Couche-Tard stock, and I added this to my shortlist, and I hopefully will start a new position in this company if the share price remains the same in the next couple of weeks. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar stock analysis videos. Thank you for watching, and I hope to see you guys in the next video. Farewell.